So anytime you're looking out 6 months or a year, it's really hard to predict what's going to happen next. And I think there are lots of concerns that people have, whether it's tighter monetary policy, whether it's the fact that our economy is running red hot. And so for some, that might feel like, okay, well, it's time for some kind of pullback in the market or slow down the economy, or whether it's some of these global trade talks. I think there's no shortage of things to be concerned about. The one thing that's important for a long-term investor to remember is that losses are a normal, healthy part of a well-functioning market. And I think given where we are in a bull market, you can look back at the history and see since 1945, bull markets typically have a 5% pullback every 12 months and a 10% pullback or more every 3 years or so, and a 20% or greater pullback every 5 or 10 years. So generally speaking, expecting downturns and periods of resetting to occur with the same frequency and magnitude as they have in the past is typically going to be an easier route for you to plan around than trying to predict the what and the why and the when.
Yeah, there's almost, but listen, there's almost, Peter, a greater concern among some of the folks that we talked to on CNBC about the fact we haven't had that pullback. It's not like we're, cheerleading the market up. It's, whoa, why aren't we getting these little pullbacks which are healthy? Do you think the structure of the market has changed vis-a-vis ETFs or index funds, that maybe all these historical sort of comparisons just aren't going to be relevant anymore? I don't know.
Well, I do think, look, the market doesn't operate on a schedule. And I think what we have had...
It would be doggone easier if it did, by the way.
Yeah, it would definitely make my life easier. And I think throughout this entire recovery, I think we're going to look back at history books and call this the most hated bull market ever. And when you climb that wall of worry, that can be good. But look, consumer confidence is as high as it's ever been. You have a lot of positive investor confidence measures ticking upwards. Confidence is very high. Whether you're going to say valuations are priced to perfection, it's hard to make that kind of judgment. But what you can say is that valuations are at a level where you would expect over the next 10 years returns to be a little bit below historical averages. And the path to where you get there, when these turns happen, we've had 10% pullbacks in each of the past few years. So it's not like they haven't happened, but we did have a prolonged period where they didn't happen. And I think that the important thing for an investor is to have a plan, not to be complacent, and so that when the inevitable does happen, that you're ready for it and that you're invested appropriately.
Let me make the sports analogy, though. You could have a great sports team that has no fan interest. In other words, the team is good, but there's nobody in the stands. The market kind of feels that way in a sense, where things have been so good for so long, but ultimately stocks are only going to go higher if you have more people that are buying into the market, or the people that exist buying more stocks or willing to pay more for each share of stock. Do you think we can get the interest among the retail investor to come back into this market?
Well, I think when you get to the point where everybody's interested is the point in time where you might have a problem, at least if we're going to use history as a guide.
We're not there yet, are we?
No, we're certainly not. And I think when you look at what our stock market returns made of, they're made of earnings growth, they're made of dividends and buybacks, and they're made of valuation expansion and contraction. And what I think goes missed is that earnings growth, this entire rally, this entire bull market run, has been outstanding. Companies got lean and mean during the recession. Revenue and earnings growth has been off the charts. And now we're seeing, more of the psychological aspect of that valuation expansion. And trying to time it perfectly is both a matter of calculus and psychology that very few people can master. I think as more and more people step in and throw their arms up in the air and say, look, these things are going to go up forever, that would be the concern for me. I think that the fact that people like you and I are talking about where is the turn down, here are all these concerns, those are really healthy. What is the thing that pushes us into recession? Nobody can realistically know that in advance. And so, again, I think if you're concerned about the underlying fundamentals of the market, or you're concerned about the global macro situation, you're far better off looking at those assumptions in your underlying plan that derived your portfolio in the first place than trying to make a change in advance. Because I think most people are going to end up losing more money trying to anticipate a correction than they might lose in themselves.